Well, South Africa's second biggest private hospital group, Life Healthcare, has fallen short of market expectations. That's for its full-year profit after writing down the value of business. Now, with demand for private healthcare rising in South Africa due to a fast-growing middle class taking up medical insurance, Life Healthcare's earnings on a longer-term basis are expected to increase. Now, we had an 11.5% increase in their revenue line to 11 billion rand, and diluted HEPS up 18% to 141 cents for the full year. Joining me now to give us some insight into the numbers, we've got Group CEO Mike Flemming joining us. Thank you so much, Mike. So how has the full year period been for you?
Well, we feel quite bullish and rather surprised at the market reaction. You know, we've had very solid activity growth, which is really what drives this type of industry. And we've always been forecasting and giving guidance around the 10, 11, 12% top line and a middle teens for our EBITDA growth. And then below that, it's corporate activity that drives those numbers. So we feel comfortable. I think there's probably some misunderstanding around our dividend declaration, where although this H2 was only up 11%, you know, year on year is 23%, and it talks to a change in philosophy that we introduced in H2 of 2011.
Mike, when you look at the South African healthcare industry, what's the real danger of further government intervention? I mean, in my view, the government seems almost hell-bent on stamping out capitalism in healthcare. They want it done almost at cost.
Well, we hope we disagree with you on that one, but we certainly will see more regulatory interference. Okay. The government is intent on looking at the affordability of healthcare in South Africa, and we acknowledge that we don't believe that the healthcare is expensive. It's about the question of affordable to more South Africans. I think the government is going to be working towards some understanding of that. Whether that leads to further regulatory interference in the form of a pricing mechanism is a possibility. So I'd agree with you, we're going to see a lot more interference in our patch.
I mean, just put that into context for us for the full year. What type of inflation did you have when it comes to the cost of staying in your hotels?
Hospitals.
But perhaps some might see them as hotels, hopefully.
perhaps Freudian.
Yeah, Freudian, our
look, our 11.5% roughly is divided into 6.1% of activity, and therefore 5.4% of pricing. Pricing is a little bit incorrect in that we have a sales mix issue. You know, we have different products that cost less per unit of output. But our medical inflation is probably running at a tad under 7%, which is in excess of CPI. Is that affordable on a sustainable basis for the next 10 years? Obviously not.
Yeah, and of course that was where government wants to bring down prices. But you've also got, price pressures to deal with. I'm sure very energy intensive in a hospital like yourself.
Yes, energy is a rather small part of our overhead costs, but certainly 15, 20, 25. Rates and taxes also very high numbers, water very high numbers. I think the biggest issue that we face, like most South African businesses, is labour. Our biggest competitor now is the state. The state has pushed its salary increases for its workers in double digits for many years now, and that pressure is starting to bear on us.
You've got this kind of long-term plan in place for senior management when it comes to trying to retain top management, and then also the share incentive scheme for employees. Tell us about that and how you feel like it might help keep quality staff with you.
Well, certainly in terms of our employees, the best thing we learned when we listed was the value we got out of paying some of that gain back to our employees, and the gratitude and certainly one of the nicest things I've had to do as a CEO. We've mirrored that again once, and it is a retention strategy. The employees will participate in dividend flow from day one, but the actual equity or capital profits will only accrue from year 5 through 7. So that will be a substantial sum of money. We invest 50 million a year. It's buying shares in the open market, so we don't hope to dilute in that way. And we think we'll get significant value and retention of key staff.
Now, Mike, what about future growth now? Outside South Africa, how do you stand on that?
Yeah, very bullish because of our investment in India.
Yes.
We've been able to get traction on the improvements that we require in terms of profitability there. We bought an asset that had 2,000 beds with only 1,000 operational, so you had that redundant capacity. So without capital spend, we can grow that business double. In this past financial year, we've seen a 34% growth in activities in in that space. So we look forward to significant growth out of our existing asset in India. And then, of course, the Indian story.
Yeah.
We've been very cautious. We haven't taken off more than we can chew. And so we believe in that story, and we believe that we can make some significant growth.
I assume with the Indian healthcare sector or hospital sector, it's very much like India as a whole, where it's a case of scale, because profit margins are quite tight. Is that the case with your business? I mean, what type of numbers in terms of beds do you need to have a strong contribution to bottom line for the overall group?
Certainly at 2,000 beds, we think it should make a difference. The Indian margin, if we see Apollo recently announced, they're a listed company, and they recently announced their results with some pretty hefty margins, 24% if we got our calcs right. But generally margins are significantly below South African levels. But the problem is not so much input costs, but really that the pricing line is very competitive. Most of your patients are off the street, self-pay we call them, with a 90% cash payment versus in South a 90% insured patient.
And lastly, you mentioned Africa, the west and east coast of Africa. You're going to make an acquisition on the continent?
We hope so. The big problem with what we buy and sell is that it's intellectual capital. So we haven't got the management bandwidth to do the work in Africa that's required. So we formed a joint venture with the IFC, and together with them we will try and identify opportunities in those hubs. To date, it's been a reactive type of approach to acquisition, and that doesn't satisfy.